Hi, welcome back to the show. Well, one stock in focus now is Indiabulls Housing Finance. This stock has been on the traders' radar after the company has been added to the MSCI index. And in fact, in the last, just pull up a one-month chart and you'll see there's been plenty of traction there. Gagan Banga, the Vice Chairman and MD of Indiabulls Housing Finance, joins us now to talk about the way forward for the company. Gagan, hi, good morning, and thanks for joining us on the show. It's been a very good quarter for you, the quarter gone by, that is. You know, NII growth of 26%, profit growth of 20-odd%, and asset quality has been maintained quite stable as well. Give us a sense of what the quarters to come will look like and where the growth could come in from.
Yeah, so in about 2010, we had actually guided on the fact that in the foreseeable future, we see the business growing by between 20 and 25% across various financial parameters. That was the time that we had really started focusing on the whole home loan and the related mortgage opportunity. And as time has gone by over the course of the last 5 years, very systematically, we've gone about operating within that range of 20 to 25%. And as we sit in the second quarter of financial year 16, in the foreseeable future, I expect that business should continue to grow at 20 to 25%. Last year, we got a series of credit rating upgrades, which has allowed us to, while keeping our margin stable, actually gain reasonable market share in the whole home loan opportunity. In the home loan space, we focus in the space around 25 to 30 lakh of rupees of loans, which is the one segment of the real estate market which continues to see reasonable traction even today. So given where our cost of funds are, our credit ratings are, and the capital is, I'm reasonably confident that in the foreseeable future, this 20 to 25% would continue to get replicated quarter by quarter.
Okay. How will margins pan out, Gagan, you think?
Our spreads have been maintained at give or take 300 basis points, and whatever additional savings we've had given the rating upgrades and the overall interest rate downward cycle that the country has been witnessing over the course of the last 12-15 months, all of that benefit has either been passed on to the customer or has been utilized to get some more market share or create counter-cyclical buffers. I think the strategy would be to, on the longer term basis, maintain spreads at about 300 basis points, and whatever savings that we get on the basis of all of these savings, we will use them to pass on to the customer.
Okay. You have a loan against property segment as well. I would assume that you will lend to other real estate developers as well. What is your non-residential component? Non-residential, non-retail component?
So the non-retail component is at about 22%. About 60% of that 22% is lent out in structures which are actually remote to the real estate developer, which is in the form of discounting of rents of fully leased out commercial buildings, and the balance 40% is residential construction finance. So approximately 8 to 10% of our balance sheet is exposed to residential construction finance.
Okay. Within that, can you just throw some more light on the home loan demand? I heard you mention that the 25 to 30 lakh category is still doing well, but we've seen a big fall in registrations in the high ticket segment, you know, the 1.5 to 2 crore category. What is your own exposure to that segment? And in general, because you lend to this space, how long do you think it could take for a recovery to come through?
So the 1 crore plus segment has been pretty negatively affected by the fact that mortgage rates in India continue to be at about 10%. Rental yields are only at about 3%. Historically, this gap has been 4 to 5%, and people still would invest in properties with the gap of 5% because there was a general expectation of capital gains. Given the gross oversupply in the premium end of the market, that situation has changed, and unless the supply is worked through, which will take 3 to 4 years, my sense is that the premium end of the market would continue to remain slow. The lower end of the market, which is more defined by the first-time user, that guy gets a lot of tax incentives. His effective cost of mortgage net of tax incentives is only about 5%. So, for 2% he can own a house, and that mathematical equation is so strong that you continue to see very good momentum, not only in our books but also in the overall housing finance industry. So housing finance companies have been growing at about 22%, much in the same range as we have been growing. And that is largely because of the tax swaps. The mortgage rate comes down to only about 5%, and there is tremendous incentive for first-time users to buy a house.
Okay.
So my sense is the lower end of the market continues to remain strong over the years to come. Higher end of the market would have 3 to 4 years of supply, which it needs to work through.
Okay. Just a word more on your non-retail segment, which you said is 22%. Does that give you a much better spread?
Yeah, intuitively, large loans tend to have a chunkier type of profile. They would give more spreads. They also require more provisioning. And any business would, require several legs to stand on. It's a very critical leg for us. And historically, given our risk management practices, has done extremely well from an ROA perspective.
All right, Gagan, all the best for the quarters to come. Thanks for joining us. That's the word coming in from Indiabulls Housing Finance. That stock has been a big mover. In fact, this year, it's given returns of almost about 70-odd%. That chart should be up for you on your screen. While the market is flat,